everyone. Welcome back to Cheddar. I'm Hope King, joined by JD Durkin.
Happy Tuesday, everyone. It's good to be with you, Hope.
Happy Tuesday. Welcome to the second hour of Cheddar Closing Bell today. Let's take a look at how the markets closed out the day. Up across the board, lots of green on that screen. 43 points. The Dow was up 20,938. The S&P up as well, up 4 points, about 0.2%. And the Russell following suit along with those other major indexes, up about 0.2% as well. So lots of good news today for investors and some good news for college graduates this year entering the workforce. They are facing the highest starting salaries in history. That's right. Grads are getting an average salary of about $49,000, 14% higher than students who graduated 10 years ago, adjusted for inflation. Joining us now is financial advisors Ken Mahoney. Ken, good news. You were saying you were happy about this as well.
Yes.
So what advice would you give to graduates now with this new higher paycheck?
Well, it's a great job market to be a little bit more selective. Now, back in the day, 10 years ago, or 2008, we didn't have a lot of choices, right?
That's true.
And moms and dads are very happy about their investment now that the kids have all these different choices. So, but it's not about salary. They should really start looking at something that really opens up their eyes, a career path, something that gives them a lot more experience and not worry so much about the salary. I know it's hard for them to hear this advice, but to really find something they like and go along with that.
Yeah, good luck getting mom and dad on board with that plan where they're like, I want to go be an artist or I want to go be a TV host. And my mom's like, yeah, that's not going to work.
Well, you missed yesterday's segment, unfortunately. We had the millionaire maker. He came on and said, forget it. Don't forget about salaries and forget about following your dreams. Like, just try to go after the money. And one of your first pieces of advice for graduates is going after a 401k plan. And so why do you think that still is important in this day and age?
Well, because they're not going to have a pension. Millennials coming out are not going to have a pension. The best way to make a pension is a 401k. Get early, get started, you get used to it. You know, Albert Einstein said the 8th wonder of the world is compound interest. So take a 22-year-old, okay, right? Take a 22-year-old and through age 62, 40 years of compounding. Yeah. So start early. It's a good thing to get going that way.
But that's got to be tough, though, to convey that to 22, 23.
That's your job.
When I graduated out of school, I wasn't thinking about yeah, exactly. I wasn't thinking about developing a 401k, but it comes something that later in your 20s you start to take a little more seriously.
Right.
How do we get the message out more?
Right, hopefully their parents could say, look at my statement, look what I've done, look what I've accumulated is one thing. Hopefully other co-workers that have been there 5 years or 10 years say, look at this, look what's happening here. I'm putting money in, there's a match, I'm compounding growth, yeah. So hopefully some people around them will show them what has worked.
What are we attributing the current state of these high average salaries to across the board? Back when Hope and I finished college, the starting salary average was not anywhere near as high as it is now.
Well, we finally see some turnover. We see the job market stronger. Now, thankfully, like back in 2008, 2009, there's very little turnover. You had a job, you held on to it.
Yeah.
Now with confidence, the business survey confidence, consumer confidence, we're starting to see that companies are hiring. Right. And so with that, we get some turnover, and that turnover, the college graduate comes in and slips into that spot where it's now open because of that turnover. So turnover is actually positive. Again, not so much for employers, but for employees, yes. The turnover is a very positive aspect.
Yeah, from an administrative standpoint of view, I always look at the monthly jobs report. Back in 2008, 2009, we're losing nearly 800,000 jobs a month.
And now we're adding 240,
And now we're adding 240, 260.
Yes.
Really good months, a little higher than that.
Yes.
Slower month in February at only 98,000 jobs. But all things considering, a far cry from where we were from those years.
Exactly.
Yeah.
All right, let's talk about those student loans. So it's nice that they've graduated. It's nice that they're getting these salaries, but the pace of student loans is going up much quicker, much faster than the actual salary increase. So talk to us about how you would suggest paying off those student loans.
Yeah, so most students, they get the statement in, it says minimum payment and they pay it. The problem with that theory is that the principal continues to grow. So I'm actually advocating almost doubling the minimum payment. Don't hit me, don't fight.
Wow.
But really to get at that principal, because making the minimum payments at 7.5%, your principal is growing. You're running on a treadmill and not getting anywhere.
Right, and those first couple of payments, those first months, or even a couple of years, is really just paying that interest off first.
Absolutely, yeah, especially at 7, 8. Look, we want compound interest. We talked about that, invest in a 401k plan. But just the opposite, 7%, it keeps compounding on you. So try to stay in front. Also consider consolidation. Some people have loans all over the place, 12%, 14, 7. See if you can consolidate them for ease of use, but also consolidate them for a lower rate. Again, lower rate is 7%. Think about it. We have $1.3 trillion of college debt in this country. At 7%, it's pretty staggering. So try to stay on top of that by making double the payments.
Absolutely. And student financial loans also something that's impacted by the new budget out of the administration
That's
that's
right.
out today. It will take a while for analysts, I think, to put the full scale and scope of exactly how that impacts
But it's definitely
the market.
a cut. It's a cut there.
It's a significant cut,
Yes.
absolutely. It's at least, I think, $143 billion, if I remember correctly off the top of my head. I want to ask you specifically, because this is something that young college graduates face. Talk to us about percentage of rent that they should be paying.
Yeah.
If they are lucky enough to not live at home with mom and dad in the first year or so
Maybe they're
after
lucky to
school.
live at home and save
Well,
some
yeah,
money.
okay, that's true.
Hey,
That's fair enough.
point.
Okay, that's a
Right,
great point on the
yeah,
other
they'll
side of the
Google
coin.
man cave set up for themselves. So
I
it's a media
know.
room or something.
Hey,
No,
mom makes dinner, it's not bad.
But you
right?
really, look, you could always, hook up with a friend and do that. I mean, no more than 25%. I mean,
Yeah.
'cause it's nice to have discretionary money. We like people that are putting money back into themselves. They're getting accreditations. They're going for certificates, extra education, extra, accreditations and so forth. So we like to keep that a little bit lower, give yourself more discretionary room. Specifically, if you could actually educate yourself more, give yourself more opportunity for down the road.
No more than 25% is hard to do in New York
I know,
City.
I know. There's some room back here.
That-
Let's have a little cop out.
People would
know.
laugh
They
at
are
you in this
startup.
city when they
I
hear that
know,
number.
but
back
you got to hook
there.
up with a friend maybe and
You're exactly right.
slug away.
Did you ever account for maybe having a higher percentage for different cities, or do you always stick with that 25%?
That's a good
number?
point. So different cities, no doubt, you can get away with less. In New York City, it's probably closer to 50%. But if you hook up with a friend, you're back to that 25% if you can. But yeah, it's really challenging for sure. Say 25%, but at least gives you a goal, because you start saying 75% of my money is fixed into rent, you got very little discretionary money to work with.
How about other misconceptions that you see young investors, young college graduates hitting the market, finally earning substantial paychecks? What don't they have quite right about the money?
Spending
game?
pattern. So
Spending pattern,
there's definitely this whole time, kind of living on beans at college and giving yourself like a $100 budget and down to zero. So they get kind of splurgy, which is fine. It's all right to take that one splurge, but you start doing consecutive splurges, you get yourself in a really bad habit. So I think just be mindful of, it's nice to start getting paychecks, feeling that independence. The problem is, doing those splurgy things are going to set you back with credit card debt on top of college debt, and then you're in this vicious cycle you want to stay away from.
Right.
And I think you also advise folks to maybe invest in an extra credential or two.
Yes, absolutely.
So why that maybe over a grad degree, which I feel like a lot of these marketplaces, job marketplaces, are looking for people with an extra master's degree here and there.
Right, well, I'm hoping the companies could pay for the graduate degree, and some of these other accreditation certificates are kind of bought by your own, so to speak. But basically investing into yourself, they give you the opportunities to pivot so you're a more valuable employee and get that next promotion when it comes up.
Do you see this figure rising to the height of your intelligence? We're talking these are the highest starting salaries that we've seen in history. Do you expect this number to continue to grow? Or any of that because of inflation?
So that's average. I've seen $75,000, $80,000 in selected industries like software engineering,
of course,
computer. Again, if you're willing to go San Fran, Silicon Valley, you're going to find yourself in the $75,000 to $100,000 starting salary. So I do see this increasing as the economy expands, as companies get more confident, as there's kind of, I can't call it work shortage yet, but you're starting to feel some of the strains of that. I do think that numbers can continue to go higher.
So your best piece of advice, if you don't feel like saving money, move to Silicon Valley, become a tech genius, and then you're
There you
probably
go,
set.
go public and hit the bell and
Hey, here
call
we
it
go.
a day.
And we'll have you on Cheddar. All right, Ken Mahoney,
you better
financial
do it.
advisor. Thank you very much for joining us. It was great to have you
Great being
today.
here, thanks.